74.22 million ounces. That number dropped this morning, today, March 7th, 2026, and it changes everything you think you know about where gold is headed next. The People's Bank of China just confirmed, officially, that it now holds 74.22 million fine troy ounces of gold. That's 30,000 more ounces than last month. That's 16 consecutive months of buying. Not 16 weeks, 16 straight months. And they didn't stop even when gold hit $5,594 an ounce in January, even when most retail investors were running for the exits, even when every pundit on financial television was calling the top. They kept buying. And right now, as of this week, gold is trading at approximately $5,152 an ounce, down from a war-driven spike above $5,400 just days ago, but still up more than $2,200 from exactly 1 year ago. That is a 74% gain in 12 months. And what I'm going to show you in the next 20 minutes is that what China is doing right now, quietly, methodically, with almost no fanfare in Western media, is not just a financial hedge, it is a geopolitical statement. It is a declaration about who controls the monetary system of the 21st century. And if you understand the pattern I'm going to lay out for you, you will never look at gold the same way again. So stay with me, because by the end of this video, you're going to understand exactly why this $5,152 price is not a ceiling. According to the data, and we're going to go through all of it, it may be closer to a floor. Let me start with some context that the mainstream financial press is almost completely ignoring. On February 28, 2026, the United States and Israel launched coordinated strikes on Iranian targets. Within 72 hours, gold went from around $5,100 to a peak of $5,417 per ounce. That's more than $300 in 3 days. Oil surged 13% in a single session as fears of Strait of Hormuz closure spread through global markets. Gold futures on COMEX broke through $5,400 for the first time in history, and silver briefly touched $96 an ounce before pulling back hard. Now, gold has retraced somewhat. As of March 6, 2026, spot gold is trading around $5,097 to $5,152, depending on the session. And what I find far more interesting than the war-driven spike is what happened before the war, what was already in motion. Because the China PBOC number that dropped today, 74.22 million ounces, that is not a reaction to the Iran conflict. That is February's data. That buying happened before the latest escalation. China was buying gold methodically, every single month, with the precision of a surgeon, regardless of price, regardless of global events. That's the detail that should make every investor sit up straight. Now let me give you the full picture, because when you see the sequence of numbers here, something clicks. According to Bloomberg's data published just hours ago, the PBOC held 74.12 million ounces as of November 2025, then 74.15 million in December, then 74.19 million in January 2026, and today, 74.22 million. Every single month, an increase of precisely 30,000 ounces. Not 28,000 one month and 35,000 another, exactly 30,000. Every single month. Now you might think, okay, that's pretty small relative to the overall holdings, and you'd be right if you looked at it in isolation, but context is everything. The PBOC's total gold reserves are now valued at approximately $380 billion at current prices. Gold now represents 9.6% of China's total foreign exchange reserves, up from less than 3% a decade ago. That shift in allocation is not an accident. It is a policy decision at the highest levels of the Chinese government to reduce dependence on the US dollar as the backbone of their reserve structure. And China is not alone. According to the World Gold Council's March 2026 Gold Monitor, which I'd encourage you to look up yourself at gold.org, central banks globally accumulated 863 tons of gold in 2025. That's not far off the record 1,081 tons purchased in 2022. And the World Gold Council now projects that 2026 central bank purchases could range from 773 to 1,117 tons. If that upper estimate is realized, 2026 would rank among the strongest years of official gold demand since 1971. Since 1971, the year Nixon closed the gold window. You see how those dates line up? There's a reason for that, and we're going to get to it. Quick note before I go deeper. My analytics tell me about 3 out of 4 people watching right now aren't subscribed to this channel. If this kind of research, going straight to the source data, cutting through the noise, is useful to you, hit that subscribe button right now. It genuinely helps the algorithm surface this content to more people who are trying to make sense of what's happening in these markets. That's really the whole point. Okay, back to the data, because this next section is where it gets really interesting. To understand why what China is doing matters so much, you need to understand a pattern that has repeated itself at least 3 times in recorded financial history. And I want to walk you through each one specifically, because once you see it, you cannot unsee it. The first example is the decline of the Dutch Republic in the late 1600s. The Dutch guilder was the world's reserve currency for most of the 17th century. The Dutch East India Company, the VOC, was essentially the largest corporation in human history at its peak, controlling over half of global trade. But here's what happened. The Dutch overextended militarily. They fought expensive wars against England and France simultaneously. To finance those wars, they debased their currency and issued debt at an extraordinary pace. And what did foreign creditors do? They started quietly converting their Dutch guilder holdings into gold and silver. Not overnight, gradually, over years, accumulating physical metal while confidence in the paper system slowly eroded. By 1720, the guilder's reserve status was finished, and the British pound had replaced it. Sound familiar? Let me give you the second example. Britain, 1914 to 1944. The pound sterling was the world's dominant reserve currency from roughly the Napoleonic Wars through the Second World War. Britain sat at the center of global finance, the Bank of England set the price of gold, and the pound was as good as gold, literally, under the gold standard. Then came 2 world wars and the debt that came with them. By the end of World War II, the United States held more than 70% of the world's above-ground gold reserves. Britain was broke. And at Bretton Woods in 1944, the dollar replaced the pound as the foundation of the global monetary system. The transition didn't happen in a crisis. It happened through accumulated weight. Through 2 decades of the United States quietly building gold reserves while Britain spent theirs. The third example brings us to August 15, 1971. Richard Nixon goes on television and tells the world that the United States is suspending convertibility of the dollar to gold, the so-called Nixon shock. What most people don't know is that in the years leading up to that moment, France, under Charles de Gaulle, had been systematically converting their dollar reserves into physical gold. France sent ships across the Atlantic to literally withdraw gold from the Federal Reserve Vault in New York. De Gaulle understood what was happening. He saw the United States spending more than it earned, running deficits to finance Vietnam and the Great Society program simultaneously. He knew the dollar's gold backing was being stretched beyond its limits. So France accumulated gold, and when Nixon finally broke the link entirely, France was positioned. 3 different empires, 3 different centuries, 1 identical pattern. The dominant reserve currency gets overextended, a challenger quietly accumulates gold, the transition happens. The question is, where are we in that cycle right now? Well, let me show you exactly where we are, because the data could not be more explicit. The United States national debt as of this recording stands above $36 trillion. The annual interest payment on that debt now exceeds $1 trillion per year, more than the entire U.S. defense budget, more than Social Security payments, more than Medicare, just the interest. The Federal Reserve has cut rates, but rates remain at 3.50 to 3.75%, according to the latest CME Group probability data, and 95.6% of market participants currently expect rates to stay unchanged at the March meeting. Core producer prices rose 0.8% in January 2026, the strongest monthly increase since mid-2025. Inflation is not gone. It is sticky. And a government that owes $36 trillion cannot afford the interest rates it would take to kill inflation without triggering a debt crisis. Meanwhile, in Beijing, they are doing what France did in the 1960s, what the United States did to Britain in the 1930s and 40s. They are converting paper holdings into physical gold every single month, and they have been for 16 consecutive months. Now here's what makes this particular moment different from the historical parallels, and stay with me because this part is critical. The speed of accumulation. France took years to withdraw enough gold to pressure the system. The United States took decades to accumulate the reserves that unseated Britain. But China has access to something neither France nor the United States had in those earlier eras: perfect information, algorithmic trading, and a financial system large enough to move quietly through global gold markets without spiking prices. They're not buying in one dramatic move. They are buying 30,000 ounces every month like clockwork, while simultaneously watching gold's share of their total reserves climb from under 3% toward the double digits. Now let me bring in the COMEX data, because this is where the story gets a layer more complex, and frankly more alarming if you understand how the paper gold market works. According to delivery data compiled by researchers tracking CME Group filings, COMEX gold warehouse stocks peaked at approximately 43.3 million ounces in March 2025. That was a 153% surge from November 2024, driven almost entirely by tariff arbitrage. Traders airlifting gold from London to New York to lock in a spread. Swiss refineries were reportedly flying gold to the United States almost daily during that period. By the end of 2025, those warehouse stocks had declined to approximately 39 million ounces. As of the most recent data I could find, dated February 12, 2026, COMEX warehouse stocks stood at approximately 34.4 million ounces, still down roughly 21% from the March 2025 peak. But here's what matters. Registered inventory. That's the gold actually available with warrants attached for immediate physical delivery, has compressed far more dramatically. Researchers tracking this data noted that registered inventory fell by approximately 25% between March 2025 and year-end, even as total prices were hitting record highs. And what that means is this. There is less and less physical gold available to back the paper contracts being traded on COMEX at any given time. Think about that. The price of gold is being set by paper contracts on an exchange where the physical backing of those contracts has been quietly shrinking for 9 straight months. It's like a bank that keeps issuing more paper notes while the vault behind the counter gets lighter every quarter. And it's not just COMEX. Let me tell you about what's happening in Shanghai, because this dual market dynamic is one of the most telling signals in the gold market right now. For years, Chinese gold prices on the Shanghai Gold Exchange traded at a discount to London, sometimes minus 1% or more, which told you that domestic demand in China was relatively soft and that importers weren't fighting for metal. But something shifted. According to the World Gold Council's February 2026 data, the Shanghai price has now moved from that negative 1% discount in September 2025 to a positive 1% premium over London in February 2026. That's the highest premium since last April. And what a Shanghai premium means is that Chinese buyers are now paying more than the global market price. They want the metal so badly they're willing to pay a markup over the international rate. When you put that together with the PBOC's 16 consecutive months of buying, with China's full-year gold import data showing 675 tons of net imports in 2025, even in a year of weak jewelry demand, which represents a massive 41% decline year over year in import volumes, but still 675 tons of metal moving into China, and with retail investment demand in China rising 35% in 2025 for gold bars and coins specifically, what you see is a country that is systematically building gold holdings at every level: official, retail, institutional, all moving in the same direction at the same time. And now layer on top of all of that what just happened geopolitically. Because the US-Iran conflict that began on February 28, 2026, is not just a short-term catalyst for gold. It's a structural shift accelerator. Let me walk you through the timeline. On February 28th, according to multiple Pentagon and IDF statements, a coordinated air and missile operation was launched, targeting Iranian military infrastructure. By March 2nd, gold had surged from roughly $5,100 to an intraday high of $5,417, one of the single largest two-day moves in gold's modern history. Oil jumped 13% in a single session. The Strait of Hormuz, which carries somewhere between 20 and 30% of the world's seaborne oil, faced closure fears. And according to the U.S. President's own public statements, this offensive was expected to continue for 4 to 5 weeks. Now, the gold-silver ratio compressed to approximately 57 at the peak of the move, meaning silver was briefly outperforming gold, which historically has been a signal of a strong bull phase in precious metals. Silver touched $96.40 before a sharp intraday reversal crashed it roughly 7%. The volatility itself tells you how wound tight these markets are. One piece of news and the spring uncoils violently. Peter Grant, Vice President and Senior Metals Strategist at Zahner Metals, said publicly on CNBC, and I'm paraphrasing here to stay within fair use, that the macro fundamental factors remain broadly supportive of gold, and that as long as the Iran conflict is ongoing, that support remains intact. He stated plainly that he remains bullish and expects new all-time highs. JP Morgan analysts, according to reporting from Disruption Banking, were already flagging a 5 to 10% risk premium jump even before the March 2nd moves and are still targeting $6,300 or higher in their longer-term outlook. But here's where I need to ask you something, and I want you to really think about this. If the physical market is tightening, registered COMEX inventory falling, Shanghai trading at a premium, 863 tons of central bank buying in 2025, and if the paper market can still be moved violently up and down by futures positioning on COMEX, what does that tell you about the reliability of the paper price as a true signal of physical supply and demand? This is not a conspiracy theory. This is documented market structure. COMEX gold futures are a derivatives market. According to Lincoln Park Financial's own description of the product, most traders close or roll their positions before delivery. The combined average daily volume for gold futures and options regularly exceeds 300,000 contracts, but actual physical delivery is a fraction of that. You have an enormous paper price-setting mechanism sitting on top of a physical market that has been draining steadily for months. And here's the moment that crystallizes this for me. In December 2025, according to detailed delivery analysis from researchers tracking CME filings, Wells Fargo's proprietary desk absorbed 42,900 ounces in a single December 19th settlement, a $187 million commitment. Morgan Stanley simultaneously accumulated 44,000 ounces. HSBC and ADM added thousands more. These are not retail investors. These are the largest financial institutions in the world taking physical delivery of actual gold bars from COMEX vaults. Not paper, physical. What do they know that the average investor doesn't? When the smartest players in the paper market start pulling physical metal out of the exchange warehouses, that is a tell. That is the equivalent of someone quietly walking toward the exit before the fire alarm sounds. Now I want to show you the smoking gun, and for this part, I need you to think about central bank behavior globally, not just China. According to the World Gold Council data I referenced earlier and the State Street March 2026 Gold Monitor, central banks globally bought 230 tons of gold just in the fourth quarter of 2025. That's up 6% quarter over quarter, and the composition of buyers is remarkable. Poland's central bank governor Adam Glipinski reiterated his intention to increase reserves to 700 tons for what he called national security reasons. The National Bank of Kazakhstan added 57 tons in 2025, the highest annual buying since 1993, with their governor stating publicly that they want to stay a net gold buyer until global tensions ease. Brazil's central bank re-entered the gold market after a 4-year absence, adding 43 tons between September and November of 2025. Uganda, a country most investors never think about in the context of gold, announced in early March 2026 that it will begin purchasing at least 100 kilograms of physical gold between March and June 2026. Small countries, large countries, emerging markets, developed economies, all doing the same thing, all reading the same map. And that map says, reduce dollar exposure, increase gold holdings, now, before the window closes. You see, here's the uncomfortable mathematical reality. Total global mine production in 2025 was approximately 3,672 tons, according to World Gold Council data. Central banks alone bought 863 tons of that. If the 2026 projection range of 773 to 1,117 tons holds, central banks will be absorbing anywhere from 21 to 30% of total annual mine production. Add retail investment, industrial demand, and jewelry consumption on top of that, and you have more demand than supply can physically satisfy at current prices, which means either mine supply expands dramatically, unlikely in the short term given that UBS analysts noted in early 2026 that mine production growth is forecast to be very limited in 2026, or prices continue to rise until demand is rationed at higher price levels. That is not speculation. That is supply and demand arithmetic. Let me bring this back to the here and now, because I don't want you to lose the thread of what today's PBOC announcement means in practical terms. China's 74.22 million ounces, at today's approximate spot price of $5,152, is worth roughly $382 billion. But more important than the dollar value is the strategic significance. When the PBOC started this current buying cycle in November 2024, gold was around $2,600 an ounce. They have continued buying every single month as gold doubled in price. Think about that. At $2,600, buying gold was arguably cheap insurance. At $5,152, buying gold is a policy statement. You don't buy the most expensive form of insurance ever offered if you think you won't need it. You don't keep buying the same asset month after it's already doubled in price unless you believe the price is going much higher, or unless you are so certain of the structural thesis that price becomes secondary. China's own economists have been explicit about this. Wang Qing, chief macro analyst at Orient Golden Credit Rating International, said clearly in January 2026 that increasing gold holdings remains a long-term strategic direction for China's central bank, not a short-term trade, not a reaction to any single event. Wen Bin, chief economist at China Minsheng Bank, pointed directly to the de-dollarization trend and the erosion of confidence in the US dollar's creditworthiness as the fundamental logic underpinning the long-term case for gold. These are not fringe voices. These are senior economists at major Chinese financial institutions delivering official policy analysis. And they are saying, in plain language, that the dollar's dominance is weakening and gold is the hedge. So what does all of this mean for you specifically? I want to get very practical here, and I'll be clear that nothing in this video constitutes financial advice. Always consult a qualified professional before making any investment decisions. But here's what the data tells us in concrete terms, and you can verify every single source I've cited today independently. First, the floor for gold appears to be around $5,000 based on multiple technical and fundamental supports. According to Light Finance's technical analysis published March 6, 2026, the key support level heading into next week is $4,996, and the bullish scenario targets $5,426 and above. The World Gold Council's central bank buying projections for 2026 suggest official demand alone is substantial enough to support prices at or near current levels, even without geopolitical premium. Second, if you are currently holding gold, whether physical bullion, ETFs like GLD or IAU, or gold mining equities, the structural case for your position has not weakened. It has strengthened. The factors that have driven gold from $2,600 to $5,100 in 14 months, central bank accumulation, dollar erosion, geopolitical risk, and the mathematics of supply versus demand, are all still fully intact. The PBOC data released today confirms that. Third, if you are thinking about entering the gold market for the first time and the price feels high, I understand that instinct. But consider this. Every time gold breaks through a major price threshold, $1,000, $2,000, $3,000, people say it's too expensive to buy. And every time, looking back a few years later, that price looked like a bargain. The structural thesis here is not a short-term trade. It is a multi-year, potentially multi-decade rebalancing of the global monetary system away from dollar dominance. That process does not happen in a few months. It takes years. Which means if you're thinking about gold as a 3 to 5 year holding with a portion of your savings, the price you pay today looks very different in that context. Fourth, watch the Shanghai premium. When Chinese gold prices are trading at a premium to London, it signals that physical demand is strong and domestic supply is relatively tight. We are currently in a premium environment for the first time since last April. That is a signal worth watching. Fifth, watch the COMEX registered inventory. If that number continues to decline from its current levels, the tension between the paper market and the physical market will build further. Markets can stay irrational for a long time, but physical inventory cannot be fabricated. At some point, physical reality overrides paper price. Sixth, watch the monthly PBOC data releases. They come out the first Saturday of each month. Today's number was 74.22 million ounces, up from 74.19 million in January. If this buying streak extends to 17, 18, 20 months, which based on China's stated policy direction appears likely, it signals that the long-term structural bid under gold remains intact, regardless of short-term price volatility. Seventh, and this is perhaps the most practically important point, the Iran conflict creates a specific kind of volatility that creates both risk and opportunity. Short-term spikes driven by war news can overshoot fair value, and pullbacks to support levels like $5,000 to $5,100 have historically been absorb and recover patterns in this current bull market. If you are a longer-term accumulator, those pullbacks are not things to fear. They are the price you pay less than you would have in the spike. Now I want to bring this all the way back to where we started, because I want to make sure the full picture is clear before I leave you with this. This morning, March 7th, 2026, China's central bank released its monthly reserve data. 74.22 million fine troy ounces, up 30,000 ounces from last month, up from 74.12 million in November 2024 when this latest buying cycle began. 16 months in a row, not one pause, not 1 month of selling. Meanwhile, gold is trading at approximately $5,152 per ounce, $2,188 higher than it was a year ago. That's a 74% gain in 12 months. The record high sits at $5,594.82, set in late January 2026. We are currently about $440 below that record. Analysts at Bloomberg and UBS have raised their medium-term price forecasts, with the upper target now above $6,000 per ounce. The geopolitical backdrop, an active military conflict involving the United States, Israel, and Iran, with the Strait of Hormuz under threat, has injected a risk premium into gold that did not exist 2 weeks ago. Central banks globally are on track for one of the strongest gold buying years since 1971. Mine production growth is forecast to be minimal in 2026. COMEX registered inventory has fallen roughly 25% from its peak. Shanghai gold prices have flipped to a premium over London for the first time in nearly a year. Wells Fargo, Morgan Stanley, and HSBC are taking physical delivery of gold out of COMEX vaults. Every single piece of this puzzle points in the same direction. The three historical precedents I walked you through, the Dutch guilder in the 17th century, the British pound in the 20th century, and the dollar's break from gold in 1971, all share one common thread. In every case, the people who saw the transition coming and positioned accordingly preserved and grew their wealth through the chaos. The people who dismissed the signals, who said the existing system would last forever, who trusted the paper over the physical, they did not fare as well. I'm not telling you the dollar is about to collapse tomorrow. That's not what the data says. These transitions take years, sometimes decades. What the data says is that a systematic, deliberate, globally coordinated effort to reduce dependence on the dollar and increase gold holdings is underway right now, today, and has been building for years. The PBOC's 74.22 million ounces released this morning is one more monthly data point in a trend that is absolutely unmistakable. The signs are there. They are documented. They are public. The question is simply whether you see them. Before I wrap up, drop a comment below and tell me this. When you look at today's PBOC number, do you think China is close to its target gold allocation? Or do you think this buying continues all the way through 2026 and beyond? I genuinely want to know what you think. I read every single comment on this channel, and your perspective helps me understand what questions this community is trying to answer. That's what shapes what I cover next. If you made it to this point, you now understand something that most people watching financial news today simply don't. The deep structural picture behind today's PBOC headline, why it matters, and how it connects to a pattern that is repeated across centuries of monetary history. If this channel delivers that kind of analysis for you regularly, please subscribe. That's how I build the community that makes this work possible, and it's how the algorithm surfaces this content to people who actually want to understand what's happening beneath the surface of the markets. Next week, we are going to go deep on silver. Because everything I've described today about gold, the physical delivery pressure, the paper versus physical disconnect, the institutional accumulation, is also happening in silver, but in some ways more dramatically. And the silver story has an industrial demand layer that gold doesn't have, which creates a completely different kind of price dynamic. You're going to want to see that analysis. Make sure you're subscribed so you don't miss it. Until then, stay curious, stay skeptical, and always verify the numbers yourself.